So in my recent video where I talked about Phil Town's option contracts that were still open at the end of Q2 2025, one of those stocks that showed up is brand new that we've never seen before, and that is Amazon stock, ticker symbol AMZN. So I want to talk about this company in this video here today. Why would Phil Town be interested in Amazon stock? So we're going to do a quick business overview of the company, then get into a 10-year financial history on the business, see where they've been, and then look at potential earnings going out into the future, figure out what the growth is there, and come with a fair value of the stock. All right. And if you want to check out that video that I did recently of Phil Town's option contracts, I'll put a link up here. You go click on that and go check that out. It's pretty interesting overall. Now, my name is Justin. I'm a value investor. I'm a big Phil Town fan. You can see a bunch of books behind me. There's some across from me in my bookcase over there. Bunch of value investing books there. I personally have a portfolio as well too. I've been managing for several years. Did also a recent video on that one, which you can check up here. I'm up about 97% on different stocks in my portfolio, easily being the market over the last few years, which I'm very, very happy with, obviously. And spoiler alert, Amazon is one of those stocks in my portfolio. I think Amazon is an incredible, incredible company, but is it on sale? Let's talk and kind of find out in this video. So before we get into the business overview, hit that like button. Helps out the video a lot, helps out the channel. I personally appreciate it, push it out to more people. So thank you in advance. And think about subscribing to my channel, almost at 20,000. I'd love to see you on board for that. So let's talk about Amazon. You know, why am I invested in it, right? Why might Phil Town want to invest in it? Well, Amazon's one of the largest companies in the entire world. They've had some amazing growth over the last 10 years. Right now, about 60% of their revenue comes from North America, or another about 20% comes from international markets, and then around 20% comes from their AWS, which is their cloud business. Now, when you think of Amazon, at least when most people think of Amazon, they think of Amazon.com, right? The e-commerce business of Amazon, which is incredibly powerful, which has its own really moat as far as a networking moat, cost efficiencies there, right? And that business should continue growing out in the future. But I think really where the two areas that Amazon's going to grow, especially from an operating margin income perspective, is their cloud business and also their advertising business as well. Their advertising business, I think, can eventually get into that 25 to 30% type margin range, which is very similar to, say, like, Facebook has been in the similar revenue perspective when it comes to their advertising business overall. Keep in mind that Amazon just 2 years ago had around a 9% operating margin for the entire business. This year, it's going to be over 11%. So we're seeing some nice growth from an operating margin perspective, which means their earnings is also growing because their revenue is also growing. They should do over $600 billion in revenue this year. Another piece of their business that is significant is the AWS business. So we saw that it was a 20% of their total revenue comes from their cloud business. They are the biggest cloud company in the entire world, right? You have also, you have Microsoft, you also have Google in the United States as well that has, a lot of market share too, but AWS is the largest one in the space. In fact, they own about a third of that market overall, which is pretty impressive. And this is really, the part of their business right now that's generating, the most of their income, even though that AWS is 20% of their total revenue, 60% of their total operating earnings comes from their AWS business. So it is not a small feat, not a small segment of their business at all. And that should continue to grow, growing out into the future. And that's even just having, their e-commerce business too on the side, which is doing absolutely phenomenal and should continue to do phenomenal going in the future. But that has smaller margins than, say, their AWS and their advertising business. But it's still, overall, their operating margins should continue to grow. Now let's talk about their financial history. We're going to look at a 10-year financial picture of where Amazon has been going back 10 years till today. It'll kind of give us really a good picture to see the type of growth, which is absolutely amazing and crazy that a company like this has grown that fast and continues to grow really, really fast. So let's go do that now. So on the screen right now, you can see the Rule 1 numbers. You can see sales per share, for example, all the way to the left here, all the way to return on invested capital to the right. Now, you can see over the last 10 years that market cap has grown from 143 billion all the way up to 2.4 trillion dollars here in the last week. So obviously incredible growth that this company has experienced. From a sales per share standpoint, the company has grown from $11 back in 2015 to $62 here today. That is a 20% growth per year on average over the last 10 years, which is absolutely phenomenal. Earnings per share growth has even grown faster at 60% per year. Free cash flow per share has grown 18%. Book value has grown 39%. Then you get return on equity has averaged 15%. Then you have return on invested capital, which has averaged 8%. But as our earnings has grown, you can see ROE and ROIC grow quite a bit over the last 3 years. Now, I get a lot of heat and discussion topics on why I'm looking at on a per share basis, right? And the reason why I do that is I really want to know, as an investor or potential investor, how much part of my shares actually growing from those different categories that we looked at, right? If a company's buying back a lot of shares, that can really increase my per share basis. Or if they're selling a lot of shares, it can do the opposite effect. And so I think looking on a per share basis really gives me a good idea of the true growth. Because if a company is growing revenue at 10% per year, but then they're issuing, 10% more stock per year, it's really doing me no good overall. And I think it really comes to an importance when we look at Amazon. We'll see why in a little bit, where that per share basis, I think, is incredibly important to look at when you're trying to value companies and trying to figure out from a historical standpoint kind of how they've been in those different areas. But now let's turn to the balance sheet, kind of look at some metrics there among some other stuff. So let's go do that now. So here's a couple of different balance sheet metrics that I personally like to look at. The first one is long-term debt payoff. So if we look here, it's basically about 4 years that it's going to take for the company to pay off all their debt based on their operating earnings of the business. I personally like to see that under 3 years, but being at 4 years and they were at 1.8 the year before doesn't look like it's a problem. Debt to equity is 48%. That is absolutely fantastic. If it's under 75%, that's what I'm looking for. Under 50% is great. So really happy with that. And then their current ratio, also working capital, currently is at a 1. So from a balance sheet perspective, I would give, their balance sheet probably a B plus to an A minus, probably more in the A minus range, because it does look very good right now. Now let's take a look at some P&L ratios on the income statement. So we can see that gross margin has grown from 33% 10 years ago all the way up to 50% here today. So that is incredible growth on the top line, which will translate to operating margin growth, EBITDA growth, earnings growth, all that stuff, which is absolutely fantastic. So you can see operating margins have grown from 2% 10 years ago to 11% here today. EBITDA has also grown from 7% up to 20%. Now, SG&A, theoretically, you would hope to see this go down in the future, but it's actually going up from 19% to 24%. But seeing the gross margin expand where it's at, I'm not too concerned with where the SG&A is right now. Now, long term, I could see them improve on that, but there's absolutely no concern right now. And lastly, let's take a look at what the multiple has been for this company over the last 10 years and also where their shares are at. So 10 years ago, their P was negative because they have negative earnings. Today, it's at a 34, but you can see it really go down from 900 2016 all the way to 34 here today. Now, shares outstanding has grown over the last 10 years, going from about 9.4 billion shares 10 years ago to 10.6 billion shares here today. So that is 1.2% growth per year of them issuing more shares. So that's why I was saying it's really important to look on a per share basis, especially when it comes to Amazon, because they're issuing a ton of shares. Now, what they're doing is really it's stock-based compensation is where I think most of this is coming from. Needless to say, it's really important to understand that your piece of the pie is shrinking every time they're issuing more shares. Interestingly enough, you look at other companies that are of similar size, a Microsoft, you look at a Google, Apple, they're actually buying shares back where Amazon is actually issuing more shares overall. So Amazon historically has really taken every single piece of free cash that they've had and put it back into the business. They are arguably the best capital allocator in the entire world. I think them and Microsoft are, because they're able to utilize, or they have been able to utilize their capital very wisely in building out the company. You look at Microsoft, for example, they don't really go invent new stuff typically. They go buy other companies. That's what Amazon is doing too. That's how they've grown their footprint. And it's really increased their e-commerce business. If you go look at Amazon, look at the last 10K, they have a couple pages worth of companies that they've bought over the last 10 years. Some of them may really surprise you on the different companies they own, the services, products that you buy every single day. Amazon owns a lot of those. So, they've issued, I think, or been okay issuing more shares because they put it back in the business. They've been buying other business. They've been growing their footprint of their entire business overall. And even with Jeff Bezos stepping down, they haven't missed a beat. They're still continuing to grow very, very well. But they don't issue a dividend. They don't buy back shares. I think eventually they're going to do that. But this is still a pretty fast growing company, which is amazing at $2.5 trillion market cap. That's insane that they're growing where they're at. So now let's kind of shift gears. Let's talk about a fair value of what the stock I think is my personal opinion. Do your own research on it. I'll explain how and what I'm thinking when I'm going through this. And typically, I like to use my discounted operating earnings model. What I'm trying to do is trying to forecast revenue, come up with a good operating margin rate over the next 10 years, project out operating earnings, and then discount it back to today to get to the net present value of all future earnings to get to an intrinsic value. So let's go do that now. So on the screen right now, you can see my discounted operating earnings model. So last year, the company did roughly $637 billion in revenue. This year, they're going to do a little over $700 billion, in my opinion. I think early in the video, I said over $600 billion this year. It's $705 billion is what I'm projecting that they're going to be by the end of the year. I think the revenue is going to continue to grow over the next several years, but I think that pace is going to slow down just because of the size of the company that they are. So you can see the growth over here. So they're going to grow, I think, up to about $980 billion by 2029 on the top line, which is still incredible growth overall. Now, operating margins last year were 10.8%. I think they're going to be around 11.5% this year. I think the company's operating margin is going to grow about 100 basis points per year over the next several years. So about a percent per year, roughly, that I think the company is going to generate from the advertising revenue growth, also the AWS growth that they're having from the operating margins as well. I think that is going to what's going to push a lot of their operating margin growth into the future. So I think they're going to get to 16.5% several years out from now. So based on this information, that is a 19% growth per year on average of operating earnings. However, we need to think about what the company is doing for buying back shares. So I don't think they're going to buy back shares at all. They're going to continue issuing shares, just like we've seen over the last 10 years. I think they're going to issue about 1.2% on average shares. They're going to dilute every single year. That's what this negative 1.2 is over here. That's what I'm factoring in. So that's going to reduce their operating earnings growth by about to 17%, from 19 to 17% per year. So still amazing growth, but it will impact it overall. So based on this information that you see in front of you, I think the intrinsic share price of the company is $249. And today it's trading around 230, just below 230. So it does look like it might be slightly above fair value right now. Now, if we take a look at all my different valuation templates and what I think a good buy price might be based on the information we just went over, I think a 30% margin of safety for Amazon would be at $174. Payback time would be $187. 10 cap comes at $114. My margin of safety calculator comes at $184. So technically where the stock is at right now, it does not look like it's a buy based on these different models. But what's really important to think about, just a couple of months ago, look back in an April timeframe when the whole market crashed, Amazon did as well. And it went well below $175 back at that point in time. That's when I added Amazon to my personal portfolio because I felt it was really good value at that particular time. So based on these valuation models I showed you, it doesn't necessarily, say it's a buy right now, but what's important as an investor is to figure out where you want to buy the company at. You might deem, hey, I don't need much of a margin of safety for Amazon because I feel very comfortable about forecasting earnings into the future to figure out, what the value is today. And if you're okay with that and you're really, really positive that's going to happen, maybe you don't need a margin of safety. For me personally, I like to have a margin of safety just because I could be wrong. This is an educated guess on my part, but it still could be wrong. We have no idea. Nobody knows, exactly where every company is going to be 10 years from now or 5 years from now, even a year from now. It can be really, really difficult. Now, if you don't know how to value companies yourself, I show you how to do that on my Patreon. I show you how to do that on that discounted operating earnings model I showed in this video, along with a couple other valuation templates as well. So if you're interested on knowing how to value companies, which I think is one of the most important pieces when you're looking at stocks, go check out my Patreon down below. You get a link down there. Go check it out. Get access to the valuation templates, a video explaining how to value companies yourself. Get access to my Discord channel with about 150 other value investors in there right now. You also get access to exclusive Patreon videos, content I put out there. I post several times a week. So definitely go check that out if you are interested. So for me, overall, love Amazon. That's why I have it part of my portfolio. I think it's a fantastic company. I think it's going to be bigger 5 years from now. I think it's going to be bigger 10 years from now. What's little concerning to me is the dilution that the company is doing from a share basis standpoint. However, at the same time, I think if they really wanted to cut back, trim back, they could do that. They could do that pretty easily. I think they've just been in a spend mode for a very long time, which has helped on their tax situation as well. And this is still a pretty fast growing company. Obviously, like I said before, they right now are the biggest from the cloud standpoint. They also just own e-commerce in general. So they have a strong, wide moat, fantastic company overall. But is it a buy right now? I not necessarily for me at this time. I'd like to see it, drop below $180. Then it probably makes sense. And that's probably what Phil Town is thinking as well. We saw him sell put options around $207, some around $180. So if I had to take a guess, he's probably has some similar thoughts as me, thinking that it's a really good buy, potentially under 180, as my different models had suggested and me talking about in this video as well. So thank you guys so much for watching. Again, if you haven't already, please hit that like button before you head out. Consider subscribing to the channel. I love doing these stock analysis, talk about super investors, other stuff. Drop a comment down below. What do you think about Amazon? Do you own Amazon? Do you think it's a buy right now at today's stock price of $228? Love to hear from you in the comment section. I read every single one of those. Thank you guys so much. Take care and God bless.